A very warm welcome tonight to this important topic. It's the second of our webinars, which we have been co-hosting as members from different countries from the Green Group in the European Parliament. You have here Stasys Jakeliūnas and Ernest Urtasun. Kira Hansen could not make it tonight for unforeseen alternative appointments, but however, we will have a great webinar, I'm sure of that. Before Ernest will introduce into the subject, I would simply like to say that this webinar is about learning and discussing. This means, of course, we are a public event. You can, please don't hesitate to take photos, to take quotes of what you are hearing and share it on social media. Also, this webinar will be recorded so that everybody who cannot be with us tonight can follow it later. We had more than 550 registrations, despite of that nerdy topic, if I may say that. Because financial regulation, well, this is an issue which is a bit complicated, but it is of utmost importance, as we all learned through the financial crisis. And obviously, this is why many people are following us here, but also because we have exciting guests. So please do share your thoughts with us. For this, you will have during the event two possibilities. You can either write your comment or question in the chat, in the Q&A function. And the more do this, the more lively we will have a debate, and you can vote on the different suggestions for questions and remarks by everybody else, so that we will treat or try to treat the most relevant questions first. But you can also use the hand function. With the hand function, you can show that you would like to speak, and I will try later on to bring people into the discussion. So it would be great after we listen to the introductory talks to have your voices heard, and so that we can have the maximum out of this learning and discussion evening on this important topic on deregulation for future ? Ernest, I hand over to you.
Thank you so much, Sven. Thank you so much to everybody who is online tonight to discuss, as Sven said, a topic which is sometimes difficult for the broader public, but that it gets more and more attention. And I think that the level of participants tonight and the people that will continue coming online shows that we have to do an effort in trying to overcome the technical barriers that sometimes made us discussing those issues in a broader audience. And I think we're getting there. And I think this discussion comes at a very timely moment for different reasons. But everybody can understand that the huge economic impact of the COVID-19 crisis will have very deep effects on our financial system. There are already worrying signs on what is going on, and there are things that we need to follow very closely. We need to follow very closely the low profitability of our banking system. We need to follow very closely what is going to happen with an increasing number of non-performing loans that is going to increase in the coming months, and that it's going to be really a worrying thing from a social perspective, of course, and also something that will destabilize as well the financial system. But next to that, I have to say that we Greens in the European Parliament, we are also now fighting in the EP to stop a deregulatory push that comes from the side of some member states and the institutions with the excuse of COVID-19 crisis. So we have been presented on different levels of our legislation, on CRR, CRD, but on MiFID, and also on prospectus, different pieces of key legislative files of our financial regulation, the so-called quick fixes that the institutions and the Commission try to push to justify very quick and targeted adjustments to our financial regulation in order to ease, let's put it that way, the financial burden that the COVID is creating in the financial system. But we are really worried because in some of those reforms, what we see is that many of those are not having a justification of the situation created by the pandemic. Actually, what we are saying is an attempt to reform some of this legislation to have a long-term effect, dismantling some of the key elements of our legislation, and with elements that are not directly linked with the problems created with the COVID-19 crisis. And just recently, to put you this example, we are now at the Parliament dealing with the quick fix of the MiFID regulation, where the Commission and also some groups in the Parliament are, for instance, trying to eliminate the position limits that we managed to introduce for certain positions in commodity derivatives to avoid speculation in certain markets. And now these position limits, some are trying to take them out, or also in MiFID, the qualification of a professional investor in order to make it easier for an institution to qualify somebody as a professional investor. This is a push going on now at the European Union level to change those rules with things that have nothing to do, I would say, with the impact of COVID-19 on financial markets. So I think that tonight it's an excellent opportunity to focus on those different elements, to have a dialogue on what is going on in our financial system, what are the problems that we will have in the coming future, and what are the wrong or maybe correct responses that the institutions are giving to that phenomena. So for that, because I don't want to take a lot of your time, because I'm not the star tonight, the stars are gonna speak immediately after me, and let me very immediately introduce them to you. Firstly, we have with us our dear friend Daniela Gabor, who helps us a lot in different fights that we have in the European Parliament. Daniela is an associate professor in economics at the University of the West of England in Bristol. She holds a PhD in banking and finance from the University of Stirling, and she has been since then publishing a lot on central banking. We've been following her on governance on global banks, IMF, shadow banking. So she's very active on Twitter, and she's one of the persons also, I think, trying to create a culture of understanding finance in the broader picture and in the broader public. And I'm very happy to have Daniela with us today. Thank you, Daniela, for being with us. And we have also tonight another very special guest, William White, currently a fellow at the Howe Institute in Toronto in Canada. But until April 2018, he was the chairman of the Economic and Development Review Committee at the OECD in Paris. And we've been following the work of William White for years now. And he was one of the key persons alerting of the financial crisis that was coming in 2008, 2009. And the world would have been a better place in those years if we would have listened to his advice at that time, for sure. So thank you so much, William. It's really a pleasure to have you here. Both Daniela and William, I think that it's really a privilege to have such great speakers tonight. And so what I'm going to do now is just to give you the floor for maybe an introduction between 10-15 minutes max, each of you. And then my colleague Stasys Jakeliūnas will do a first reaction, and then Sven takes over to moderate the question and answer session. So thank you so much, Daniela. Thanks again for being with us, and you have the floor.
Well, excuse me, Daniela. Ernest, please say in Spanish the translation function. Für alle, die jetzt bei Englisch aussteigen, unten findet ihr Dolmetschen, da könnt ihr auf Deutsch zuhören.
And just to make sure that everyone can understand us, Please choose your language. There is interpretation available in English, Spanish, and German. And Ernest will announce the same in Spanish now.
A very good evening to all. Just to remind you, there is translation into English, German, and Spanish. Please select the appropriate channel so that you can follow the debate and the presentations in the language of your choice. I hope you have been understanding me, and I hope you have understood my presentation in English. But I'm sure that you will be delighted, as I am, to listen to our guests. Daniela.
Bueno, muchas gracias, Ernest, y bienvenidos.
Thank you, Ernest, and welcome to you all.
But I don't want to do that to the translators. Welcome. Let me share my screen because I promised my students that I will be subjecting everybody to slides, not just them. So let's see. Here we are, and I'll just try to work out. Okay, so I want to talk to you tonight about some of the key issues that I think are interesting to think about in terms of where we are at this particular moment and what we or I expect to happen after the pandemic passes and the struggles over the regulation of the financial system continue. And I come at these questions both as an academic that is interested in the geeky technical issues around finance, but also as somebody who's been engaged with questions of regulating finance, particularly in Europe. So I will give you more or less a European angle on things, allowing my very esteemed co-panelists to give you the broader global picture. And I want to first sort of bear in mind that the audience here is quite diverse. I want to give you the sort of overall broad argument for tonight and then sort of start digging into the more technical details, and hopefully the translators will not struggle too much. So I would say that for the past 30 years, to understand what is happening now, we need to look historically. And for the past 30 years, what we have had in Europe and globally, but in Europe in particular, we have had attempts to build, and very successful attempts to build a private-led regulatory framework for market-based finance or shadow banking that is to engineer a structural change in European finance away from this traditional bank-based financial system towards market-based finance, where a lot of financial activity occurs in capital markets or securities markets and is financed or hedged in wholesale money markets and derivative markets. Regulators and European institutions participated in this effort of allowing private financial institutions to write the rules of the game for this structural transformation, except for a very, I would say, quite a brief period of time after the collapse of Lehman Brothers and until the Juncker Commission. In these brief 6 years, what we have seen were public efforts on behalf of regulators from the European Commission to the European Parliament and several, the European Central Bank and several others, to rein in the systemic vulnerabilities of this structurally different European financial system. And we've had a set of systemic regulations decided both at global level, but also at European level, that try to increase the resilience of this market-based financial system that we have now in Europe. I would argue that these systemic regulations were stronger for global banks or for too big to fail banks, and we have several of them in Europe. They were not so strong, or they were weakened. The regulations were watered down during processes of negotiations at global and European level for what we call shadow banks and what we call shadow markets. And I'll make it clear why this is important. So we've had uneven progress in the regulatory reform of the financial system that we have. And since 2015, since the arrival of the Juncker Commission and afterwards, we have seen a slow and gradual return to this private-led regulatory design of the regulatory framework. And with the pandemic, I think this has been accelerated. What we are going to see after the pandemic are two sort of broad strategic attempts to water down the existing regulatory framework. One, trying to relax the rules around market-based finance under the guise of allowing for stronger balance sheets for the banking system, and more space on the balance sheets of the banking system. And probably more important in the great scheme of things, the climate crisis and the regulatory initiatives around climate crisis, I see signs that they are increasingly market-led, in the sense that regulators, although there is a flurry of regulatory activity around green financing in Europe, we have to be very careful that it doesn't open up the space for greenwashing in allowing private finance to write the rules of how we regulate the financial system in order to green it or to reduce its carbon footprint. So I will very quickly discuss why this new financial system that we have in Europe, that I would call a market-based financial system, is more fragile. What were the efforts to rein it in since the collapse of Lehman Brothers? And then I will finish by looking at the climate crisis and the threats and opportunities that arise in terms of ensuring that we resist the regulatory push and we regulate finance for the climate crisis. So very quickly, I thought I would try to illustrate the structural changes in European finance that we've had over the last 30 years with icebergs. I think icebergs are a helpful way of getting our head around what makes the modern financial system so much more complicated to regulate and stabilize than what we think are traditional financial systems organized around banks, right? So just for the sake of comparison, the traditional story that we have, particularly in public narratives, at the level of not the geeks that study finance, but the level of human beings that just use banks, we imagine the financial system to be bank-based. Banks make loans. When they make loans, they also issue deposits. Households and businesses use those deposits to pay each other, to invest. And what we don't see from the financial system, but is very important, what we regular human beings don't see from the financial system, but is very important, is the interbank money market, which is an unsecured market where banks lend to each other in order to be able to settle their obligations to each other. When we move deposits from one bank to another, banks then have to transfer something, and they get that something from the interbank money market. And the role of the central bank in this system is very simple in some ways, is to make sure that it manages the interbank money market as such that the pace of expansion of credit activity doesn't become too exaggerated, and it doesn't create the kind of systemic vulnerabilities that will lead to a financial crisis. We also have some additional regulations in there that we can discuss about, microprudential particularly, but that's kind of the standard story that we have in textbooks of what a financial system looks like. Now, since the 1980s, and very accelerated since the 1990s with the introduction of the euro, we have a financial system that looks very, very different. And for the purpose of illustration, of course, in this financial system, we still have banks, they still make loans, they still issue deposits and circulate deposits in the economy, but they do lots of other things. And to illustrate that, I want you to think of market-based finance as a system of extending and creating credit through bond markets, and that includes the famous securitization markets that were the sort of channel for the collapse of Lehman Brothers in 2008 at the global financial crisis. We also have the stock markets, and we have new types of assets, exchange-traded funds, and all sorts of other credit instruments that allow for credit activity to be created in bond markets and for these instruments to be traded. To finance this market-based credit activity, we have seen an explosion in what are called repo markets or wholesale money markets, where you have banks and shadow banks lending to each other against collateral. There is an explosion in derivatives markets. And this unseen part of the iceberg of market-based finance is very important because it shows us the much more complicated ecosystem of modern financial systems. So we have lots of different types of financial institutions being active in this kind of market-based finance. We call them shadow banks, we call them non-bank financial intermediaries. The important idea is that some want to take a lot of debt, they want to leverage in order to expand their balance sheets, and these are typically hedge funds or bond funds, and some want to lend the cash that they have or the bank deposits that they have in order to create some profits. These are called institutional cash pools, and they can be your pension fund, your insurance company, they can be your money market funds in the US. And banks do not disappear from this system, but what they do is that their activity becomes much more complicated. They become market makers. They intermediate activity in repo markets. They intermediate the relationship between these financial institutions that want leverage and the financial institutions that want to finance this leverage in derivatives markets, in repo markets, and in bond markets. So a much more complicated ecosystem of financial institutions in market-based finance. And why this comparison matters, first to note, is that it is something that is very present in the European financial system. I'm showing you here a graph from the Liikanen Report. For those nostalgic for an age where regulators in Europe were really intent on regulating market-based finance, they should read the Liikanen Report. It's a very important, to my mind, report. Unfortunately, most of its recommendations weren't put into practice. But what this Liikanen Report shows us is that banks in Europe do a lot more shadow banking or market-based finance in aggregate than they do traditional banking. So you see here customer deposits or a third of their overall assets, of their liabilities. Customer loans again are a third of their assets. The rest, the blue shaded areas on both sides of the balance sheet of the banking system have to do with market-based finance. So when you hear European regulators or member states arguing that we in Europe have a bank-based financial system and it's very different from the US, that is not the case. Some parts are still very traditional, but a lot of it looks like the US market-based financial system. And this is something that has not been accidental. It has been, we arrived here by design. I'm showing you here a quote from Baron Lamfalussy, who was the first, the president of the European Monetary Institute, the precursor of the ECB, and also the former president of the Bank for International Settlements. And Baron Lamfalussy makes it very clear here that European regulators have pushed for a market-centric financial system because they believed it to be more efficient in allocating capital. And they also wondered whether it is more stable. And this is a question asked in 2000 that was answered very clearly in 2008 with the global financial crisis, that this is definitely not the case. A market-based financial system is far more pro-cyclical, in other words, far more exposed and vulnerable to very large increases in asset prices and then very large falls in asset prices. And I don't want to bore you with the details of why this financial system is systemically more vulnerable, but we have a lot of evidence that this is the case. We know that it creates leverage and liquidity cycles that are much more abrupt in their amplitude. They also expose European and other US financial systems. They expose them to the funding conditions in US dollar markets. In other words, we are all moving in a global financial cycle with the rhythms of the decisions taken by the Federal Reserve. We also know that European banks since 2008, because of their activity in shadow markets or in shadow banking or in market-based finance, they were too large, too complex, and too interconnected. And we also know that crises in market-based finance happen in very different ways. The stuff that you don't see that is under the water in this iceberg of the financial system, that explodes in a crisis in very different ways from the traditional bank-based system. So you have runs on the repo market, you have fire sales of collateral securities, and including you can have very detrimental contagion effects on sovereign bond markets. And in Europe, we have experienced a crisis in sovereign bond markets that is, to my mind, not as much the fault of undisciplined sovereigns like Greece or Ireland or Portugal, but it is a consequence of decisions that we have taken of how to organize our financial system without putting in place an institutional architecture that could have stabilized it. I'm happy to answer more questions here because this is quite controversial, but I wouldn't blame fiscal irresponsibility for the sovereign debt crisis. I would blame the financial structure that we have. Very quickly, to the second point. So once we have an idea of the kind of financial system we have created in 2008, after the collapse of Lehman Brothers, regulated regulators accepted that we need to rein in to create a more resilient financial system, and also to reduce the amplitude of the cycles of debt and bubbles in bond markets or in securities markets or in asset markets. And I'm sure William White will say a lot more about the sort of balance between resilience and the reduction in pro-cyclicality. I just want to give you a very brief overview of what we have achieved since 2008, after a lot of regulatory struggles, I would argue. I think the strongest regulatory regime that we have put in place is for banks, in particularly to make sure that banks' activities in these shadow markets, in these markets that are used to finance securities positions or to speculate on particular securities or commodities, we have put in place a regulatory regime that it can come under a lot of criticism, but is definitely, I would say, the most successful of all the regulatory initiatives that we have. We also created new rules, not only for financial institutions, but for markets. And that's a very important advance, that your regulatory regime doesn't only focus on institutions, but it also focuses on markets. We have new rules for securitization markets, because the argument was, well, this is what created what led to the collapse of Lehman Brothers, the securitization of subprime mortgages. We need to make sure that there is more skin in the game. However, these rules have been watered down, and skin in the game is a very nice idea, but not so much embraced in practice. We have new rules from the Financial Stability Board on repo markets, these markets that basically amplify and create runs on shadow banks and on banks in market-based finance. But again, these rules were watered down very significantly in the Financial Stability Board. We have had some successful reform of derivatives markets, but some argue these reforms actually concentrate risk in other types of financial institutions like CCPs. And one of the reasons why we had a lot of watering down of the rules around these types of shadow markets has to do with what I would call the tyranny of the liquidity imperative. Because we are in market-based finance, financial institutions can argue that you have to take care, you have to make sure that you don't reduce market liquidity, because the moment this market liquidity collapses, then you have a financial system that basically implodes. And because of this liquidity imperative.
A bit more slowly, please, Daniela, for the translation.
Thank you. Oh, I can't see my chat box. Okay. So to come back, the financial institutions have lobbied very successfully to defend or around the idea of defending market liquidity in order to water down a lot of rules that would have created a stronger regulatory regime. Where we were less successful was in the reform of what we different types of shadow banks. We have had the reform of money market funds, which are a type of banks that can generate runs. But for example, we weren't very successful in regulating global asset managers as systemically important. So you have BlackRock, who sits on $7 trillion trillions in US dollars of assets that it manages, but somehow we don't think that it's a globally systemic institution. And there are debates on why this is the case. To my mind, it's a failure of regulatory ambitions. In Europe, we also have had significant failures on structural reform. The financial transactions tax, which many people think was intended to raise revenues at European level, was actually, in my mind, a very clever way of accelerating a structural reform of the financial system and putting it on a more resilient basis. It was defeated for a variety of reasons. The same with the bank structural reform directive, which came out of the Liikanen Report recommendations to make sure that you create more resilient banks by restricting a lot more severely their activity in this market-based financial system. What very important, while we have had very uneven and in many ways very disappointing progress on increasing resilience in the financial system through better regulatory regimes, we have unprecedented backstops and safety nets that central banks have put in place in order to make sure that this market-based financial system doesn't implode in crisis. In other words, while it's not, this financial system is not very well regulated to make sure that bubbles don't explode very significantly during good times, we now have safety nets that catch financial institutions during bad times. And one example of that is this market maker of last resort, which is another way of saying that central banks intervene directly in asset markets or in securities markets or in repo markets in order to preserve market liquidity, to stop this kind of destabilizing liquidity spirals, and without extracting in return enough regulations from the institutions that are benefiting from these backstops. I'm showing you here an example. Bank of England was the first one to introduce this formal market maker of last resort for financial stability reasons. It is a very revolutionary move in many ways for people who study closely central banking, because it basically recognizes that you can't only stabilize banks in these modern financial systems, you have to stabilize directly, intervene directly in markets, and that has lots of distributive implications. And where we are now, since 2015, with a safety net, we have gone in very many interesting directions. I'm showing you here a graph that indicates the European Central Bank, who, if we remember, before Mario Draghi promised to do whatever it takes, nearly let the European banking crisis and sovereign debt crisis explode and implode the European financial system. Now we have Madame Lagarde recognizing that the ECB is targeting spreads to make sure that everybody stays close to the German Bund in how much they pay. Every government stays close to the German Bund. And the ECB has bought this year 75% of all sovereign debt issued in the Eurozone. That is unprecedented for a variety of reasons and against very strong German objections. Very important, because we have put in place a very weak regulatory regime coupled with very strong safety nets or backstops from the central bank, coupled with austerity, the structural consequences have been that this market-based financial system is growing and growing because institutional investors and asset managers are growing and growing, not only because we have failed to regulate them properly, but also because we have eroded the welfare state and we have eroded the ability of the state to tax its corporations. So everything is in a sense interconnected, and it gives us more structural pressures towards this more fragile financial system. Very quickly, and I'll finish with that, and sorry for taking so long. Since 2015, we have had several attempts to water down the regulatory regime that I just described. And with the pandemic, with the COVID-19 pandemic, what we have seen is a reinforcement and an acceleration of these pressures to water down regimes. And let me give you two examples. I'm sure there are many, and our MEPs can give you a lot more examples of the sort of regulatory battles that they face every day. But two main issues that I see here is the return of securitization as a desirable activity and an activity that regulators are promoting deliberately in order to create, or with the argument to create, balance sheet space for banks and also for non-bank financial institutions. And now we know that the European Commission has proposed, and the European Parliament is voting or has already voted to include the sort of more extravagant synthetic securitizations in the framework of STS, or simple, transparent, and standardized securitizations of the European Commission. So we already have, since 2015, a framework for promoting securitizations in Europe. A lot of political debate and regulatory struggle has happened around what this STS, simple, transparent, and standardized securitization, should look like. We managed to keep out some very significant parts of the more dangerous securitizations out in 2015. Now the financial lobbies have come back, and I think they have extracted some significant victories. We also have preferential treatment for the securitization of non-performing exposures and loans. And here there are lots of debates whether this is a good idea or not. I would argue that for purposes of the fight against the climate crisis, this is not a good idea. This is not what we need. The second issue that I want to talk about in terms of what is ahead over the next 5 to 10 years is the deep greening of the financial system. That is an acknowledgement from regulators that it's not enough to declare your willingness to fight the climate crisis, but you have to make sure that your financial system doesn't work against you. It doesn't continue to finance fossil fuels and high carbon activities while you are designing a European Green Deal that is supposed to take us towards rapidly towards the transition to a low carbon economy. So why is synthetic securitization back on the agenda? Well, we already had it in the STS framework, which is this idea that we should promote some nice type and less systemic, less threatening types of securitization. Why is it back? Well, the argument is you have to allow banks to create balance sheet space. Synthetic securitizations that are on balance sheet allow banks to buy credit protection for some of the loans that they make from financial institutions that can sell it. And we already had this idea of allowing banks to buy credit protection for SME loans. It was already in there because, you know, SMEs are the panda of the financial regulatory world. Nobody can resist an SME argument. But there were some very good provisions of how to make sure that these SME loans are not, these balance sheet securitizations are not going to generate interconnectedness and systemic effects. The buyers of credit risk had to be either public institutions or private institutional investors that were very well protected, right? Now, this has disappeared now, and what we see from the proposals in the European Commission documentation on synthetic securitization is that basically we would be extending preferential treatment for securitizations to large corporates on the issue side and to hedge funds on the buyer side. And I have my doubts whether these are the kind of financial...
Daniela, you should come to an end, please.
Yes,
Thank
these
you.
are the kind of financial institutions and businesses that we should be helping. The preferential treatment of non-performing exposures, again, there is a question whether we should make it temporary, and I would ask whether this is a window of a strategic window of opportunity for the financial system to start building protections against a future where the climate crisis creates stranded assets. In other words, non-performing exposures that come from their inability to stop financing fossil fuels. In the climate crisis, and I'll finish now, Ernest, and I apologize. In the fight against the climate crisis, we are seeing a market-led green finance framework appearing, where we are using private taxonomies or ratings to identify what is green and what is dirty, and there are lots of spaces for arbitrage and misincentives in there. Then mandatory disclosure, although it sounds good, nice in theory, in practice, it's being, in a sense, gamed and arbitrage to make sure that it doesn't force financial institutions to disclose their impact on their carbon footprint, their impact on economic activity, but just the impact of the climate crisis on their balance sheet. And we have preferential treatment of green. This is the idea that is being promoted, that is to promote green assets, but not to penalize dirty ones. And if we want to get deep greening, and I'll stop here, what we need first is a tighter, better EU sustainable finance taxonomy. This is a public taxonomy. We should be using it for mandatory disclosure as well, and it should be tighter. And we need to start thinking about how to green both our monetary policy framework and our macroprudential framework. And there are lots of debates there. I will leave you with some references where you can read more, and I'll stop here. Thank you.
Thank you so much for that, Daniela. Sorry for cutting you at the end, just trying to manage time. And thank you so much for all your ideas. I think there's a lot of food for thought. I'm sure that in the question and answer, we'll come back to many of those issues. I now immediately give the floor to William Waite. William, the floor is yours for 10-15 minutes. Thank you so much.
Thank you very much. May I begin by thanking the Green MPs for the MEPs for the invitation to come here and speak. I very much appreciate it, and I've enjoyed it so far. I'm a Canadian. I lived in Switzerland for many, many years. Some might say I know nothing of Europe, and that probably is true. But I have been in the international business now for over 30 years, so hopefully I'll have something to say that's useful. Daniela has really focused on the second part of the agenda. If you go back and you look at the description of what we'll do tonight, it's an agenda for the financial regulation during the pandemic and beyond. And she's mostly spoken about beyond. I intend to speak about during. And this really has to do with the whole question of forbearance and the problems associated with forbearance. These are issues that were noted earlier on by Ernest. So I'm going to talk about forbearance and some of the problems associated with that. And then I want to move on to the question of more fundamental resolution of some of the problems Ernest also mentioned, which is this problem of NPLs and the problem of very low profits in the European banking system. And we have to get through these problems, as it were, that we face today before it seems to me, before starting to focus on what we might do in the future to make sure that these problems don't come back again. So I'm going to be talking about mostly about regulatory forbearance. All right, well, what has happened? I'm not going to go into that. I did a little bit of background work, and I counted 62 separate pieces of advice from the ECB, the ESR, the ESMA, the EBA, and the insurance people. So I'm not going to go into the details of all of these things individually, all 62 of them. But I will say a few words about the impact of these things collectively, because they seem to me to have the same rationale. And it's a rationale that says we need more lending to support the economic recovery. And my first point, I guess, is a relatively simple one, that just like ultra easy monetary policy, this is an approach which relies on finance to support aggregate demand and sustainable recovery. And my point is, and we'll begin with an analysis of ultra easy monetary policy because it starts with the same premise. My point would be that I don't think we should rely yet one more time on a financial impetus to increase sustainable growth. And that is for three reasons. Firstly, I think these policies are ineffective. They don't work. Secondly, they have all sorts of unintended side effects. And thirdly, when you follow policies of either ultra easy monetary policy or regulatory forbearance, it becomes enormously difficult to exit. And if you can't exit, then you have to become more and more worried about the medium-term unintended consequences. So we've got some fundamental problems right at the base of this whole thing. And I'll start off by saying a few words about about ultra easy monetary policy, and then go on to make the same points about forbearance. In each case, effectiveness, unintended consequences, exit possibilities. But I do want to make just one very simple point before I begin. And in every crisis, there's always a trade-off between getting out of the crisis and the unintended implications, between the short run and the long run. And if you go back to the Bible, you can see it there in Matthew 5:25, where he says, take no care for tomorrow. Tomorrow will take care of itself. Sufficient unto the day is the evil thereof. And then you contrast that with the story, albeit in the Old Testament. Remember about the 7 fat cows and the 7 lean cows? And the whole idea that you must prepare yourself for tomorrow. And when you think about the two great economists, John Maynard Keynes and one of the first and most prominent of the Austrians, Ludwig von Mises, you get exactly the same thing. So we've got something really fundamental here. Remember Keynes said, in the long run, we're all dead? And von Mises gave a long quote that basically said, don't do stuff today that's going to make your problems worse tomorrow. Okay? So there's some very fundamental issues here. Okay, well, let me say a few words about ultra easy monetary policy. because it's a lead up, because you make the same points with respect to forbearance. Ineffectiveness. Ultra easy monetary policy basically encourages people to take out more loans and to build up more debt. And the fundamental problem is that those debts then become a kind of headwind going forward. You know, as you build up debt, you have less capacity to spend still more money. It's moving your spending forward in time and creating a problem for yourself as you go forward. And that is, I think, an important problem. And we've come a long way down the road with respect to debt accumulation. And you see it in the banking system and elsewhere in Europe. And John Maynard Keynes, I mean, many in the general theory, actually gave a whole list of reasons why we should be worried about this kind of stuff. And the quote that I love that he gave us was, if we are tempted to assert that money is the liquid that activates the system to activity, we had best remember there are many slips twixt the cup and the lip. So my basic point here is that any approach that basically says, let's use finance to drive sustainable growth is suspicious. And I don't have much time, but I could go on and on about how consumption is being held back by ultra easy monetary policy, how investment is being held back. But I would also note, and maybe the best way to cut into this, because I haven't much time, is the unintended consequences of ultra easy monetary policy. And the first of the unintended consequences is that I think it's a threat to financial stability. Okay, so then you sort of say, well, why would you say that? And now we're back again to maybe monetary policy won't be so effective. Okay, because what happens, one of the unintended consequences of this monetary policy is that as you squeeze the margins of the banks, the lending margins, okay, you cut their capacity to make profit. You reduce their capacity to increase capital. And at a certain point, the bank starts saying, I'm going to lend less, not more, because the interest rates are lower. And this has now come into the literature. I don't know whether all of you folks know Marcus Brunnermeier at Princeton. He's originally a German person. He's come out with a new set of papers in which he refers to the reversal rate, which is that interest rate, the level of the interest rate, which is so low, and it could be well above zero, that the banks actually make less loans as opposed to more loans. So that's one of the unintended consequences. And if you think that the banks have got problems with the squeezing of margins, what about the insurance companies and the pension funds? So that's a real problem. A threat to financial markets. I think we're seeing this in so many different ways. When you have this ultra easy monetary policy, asset prices get bid right up. And then one of the questions that you have to ask yourself is, what happens when those asset prices start to fall because there's no justification for them being so high? And then you look at the banks and the other financial institutions that have bought into these things. Okay, so that creates a real problem too. And there's all sorts of others, which I won't go into. Problems with exiting, and I'll turn to forbearance directly in a moment. And maybe my last comment was a lead into that. If you have a situation, just think about it, where the banks, okay, are very vulnerable to higher interest rates, that they'll take capital losses on their bond holdings and they will therefore cut back on loans. And you think that other institutions might be in the same situation. The central bank finds itself in a situation, which is where I think they are right now, where the rates have gone down so low, they know that the rates are inclining people to do still sillier and more inventive things. So they should get out of the ultra easy monetary policy, but they can't do it, because they know that if they do start to tighten up the policy, they create the problem that they're trying to avoid. Now, the point I want you to keep in mind with respect to, and I'll get into the detail briefly, with respect to effectiveness, unintended consequences, and the exit problem, forbearance has got exactly the same set of problems that you have with ultra easy monetary policy, and why I come to the conclusion that you should be very careful in going down that particular road. So let me just sort of talk about it briefly. The effectiveness in stimulating aggregate demand. You know, how effective is forbearance? Well, there's two sides to the loan market, right? The question is, will the banks make more loans because of forbearance? And will people demand more loans because of forbearance? On the supply side of loans, my contention would be there's a whole list of arguments that I can't go into about why it won't work. For a starter, my old colleague Charles Goodhart points out that forbearance often says, and Daniela made a reference to the size of the shadow banking and the dependence of the banks in large part on wholesale funding, okay? What happens when you get forbearance? One possibility is that the people that lend to banks basically say, the regulators know something that I don't know. This is a very dangerous situation, and I'm going to withdraw from the fray. So you can see you might get more funding problems and less lending in consequence. Will banks make more loans given forbearance if they know those loans are likely to go bad? I doubt it. The third thing, and this goes back to what Ernest referred to before, okay, the question about whether forbearance will lead to a bigger supply of loans. These banks have got preconditions in the same sort of way as the people that go to the hospital with COVID-19 only die if they've got preconditions. Okay? The banks in Europe have got preconditions. And you know what those preconditions are better than I do, which is the level of non-performing loans is down, but it is still very high. Profit ratios are half of what they are in the United States. A number that I had not heard about before, but a recent article in the Bank of England or on the Bank of England website, the exposure in Europe to CLOs, they estimate at $480 billion, plus those that are in the pipeline. That's a big exposure. So there's all these reasons for thinking that even if you gave banks the opportunity to make more loans through forbearance, it wouldn't work. And Daniela talked a bit about the future, about the green stuff. If you want to talk about it from a different perspective, climate change is going to pose huge risks to the financial system. We all know that, okay, in terms of stranded assets and insurance costs and legal costs, all this kind of stuff. So just one more reason why the banks will think about themselves as weak and not be prepared to make new loans, even if there is forbearance. And on the demand for loan side, it seems to me it's the same kind of stuff as I just mentioned with respect to monetary policy. When people have already got so many debts, are they going to be inclined to take out even more if they know that they won't be able to pay them? So that, I think, is all sort of a bit questionable. On the unintended consequences of forbearance, I guess the most obvious thing is that those NPLs will build up over time. And in the end, we will wind up with disorderly insolvencies as opposed to orderly insolvencies. They will be much harder to manage. I worry too in terms of financial stability, because forbearance willy-nilly will benefit, among others, obviously, will benefit a lot of people who are only in trouble because of their own bad behavior. These are people that have taken on huge amounts of debts, corporations, they've done it on purpose, and now they're going to get bailed out. And that's moral hazard on cocaine. And I just simply don't like it. And on the exit, and I'll skip a lot of stuff here, on the exit policy, obviously there's dangers of exiting too late, and there's dangers of exiting too soon. Exiting too late, I guess one very good example is the moratorium on share buybacks and dividend payments. Suppose we allow the banks to start doing that again soon, and then it turns out that COVID lingers and the recovery lingers, and all of a sudden the money's gone and the banks need it for capital. Alternatively, I mean, if you said there'll be no more dividend payments forever, clearly the banks would have no viable business model. You know, they couldn't raise finance. So there's a choice, you know, there's a balance here. Like I said before, back to the Bible. My feeling is that there will be a tendency to hold on too long, that the forbearance will continue and continue. And what you will get is we can't stop now because the companies and the banks are going to hit a wall when the government withdraws the guarantees and all this kind of stuff. And as Daniela mentioned, there will be a natural agenda for the banks who want deregulation anyway to use this as a lever to just continue and to continue. So I won't go into it because I don't have time. I think all of this stuff is kicking the can down the road. I think there are ways in which one can not just manage the crisis, but resolve the crisis in a permanent way through permanent debt reduction. I won't go into all the various ways in which you could do this. Let me just say that there are no magic bullets. And the problem is, because the alternatives look difficult, there will be a great tendency to simply continue doing what we're doing, which is extend and pretend. And there was John Kenneth Galbraith, some of you may remember, famous Canadian economist, who once wrote, politics is not the art of the possible. It is choosing between the unpalatable and the truly disastrous. And the problem with forbearance and ultra easy is that it is easy to do. It is hard to exit. And the alternatives are unpalatable. But continuing on the path that we're on, frankly, because that path is unsustainable, implies that path is going to lead to a truly disastrous outcome. So that's basically what I have to say by way of introduction. I can come back later on the question of how do we resolve these problems. And of course, going back to Daniela's presentation, I've written a lot about the future and the shortcomings of international financial regulation and the various ways in which we might be able to do the job better going forward.
Can I intervene now to try to, well, not possible to summarize what we've heard, I don't know, congratulate the participants for the bravery to listening to this, because, you know, my impression, it's not first time I'm trying to understand how finance works. It's quite complicated. It's quite dangerous, I would say, all the instability embedded in it, and Daniela covered technically some of it. William went into fundamental factors behind it, going back to Bible times, etc., which is quite relevant. Of course, it takes more than one discipline to understand what's going on. And I would like to quote Isabel Schnabel, who is a relatively new governing council member at the ECB. You know, few people understand what's going on in finance. Some people at Econ didn't like that, but I appreciate that because it's quite difficult to understand the complexities of it. Daniela, you mentioned or compared the bank finance system and the market-based finance system, and you quite clearly indicated how these two are interrelated, and that's brings more danger and more complexity. But I would mention briefly that the banking system as such, by creating credit and creating deposits, short-term deposits, and usually long-term loans, that's structurally vulnerable very much too, because of the maturity mismatches that it's embedded into the system. So that's a problem, and how to deal with that. Of course, there are some cosmetic changes implemented, but structurally, I think we haven't resolved that. What comes to mind, William, you mentioned different authors. I'd like to mention briefly Hyman Minsky, who back in 1986 wrote a book and was published again in 2008, I think, Stabilizing an Unstable Economy. And explaining how finance works and how finance de facto destabilizes the economies on the global scene. So it's several decades past since then, and I think we have even more finance, and therefore we have even more instability in the economy because of that. My question, there are many questions, many ideas, and we'll have to listen to recordings of these two presentations for several times, I think, in order to understand and really appreciate, in more detail what's going on. My question is related to the new initiatives in the European Commission that is coming also to the Parliament and other institutions on the so-called digital or financial technologies. Of course, we have a history of that, internet banking or ITMs, etc. We can call that fintech as well. But on top of all these complexity layers, which are embedded on all the vulnerabilities, we are coming, I hope we'll deal with it somehow, but with its new elements, big tech, all these so crypto assets, I don't call them cryptocurrencies, I would hardly call them crypto assets because there is nothing behind them, basically. It's some sort of financial trash, but the idea behind it's coming from the European Commission initiative back in 2018, which is advocating for so-called innovation-friendly regulation. Now, we can know about the innovation and finance, and it could be good, it could be bad, in many aspects, but I think it nudged, using the term of one of the other authors, Nobel laureate Richard Thaler, the other institutions and some jurisdictions to create the fintech hubs. And I'm coming from Lithuania, and Lithuania is one of the largest fintech hubs in Europe. How do you see that development, financial technologies and the risks, especially related to the crypto assets? And one of the ideas maybe to stabilize the system is the so-called central bank digital currencies. There is an initiative now, the global initiative also, and we're covering that in the Financial Technology Working Group, which I have an honor to share. And, there are very serious and interesting implications for this project, going beyond the payment systems, possibly also restructuring the banking system and maybe solving some of the problems. So, all these, innovation-friendly regulation and fintech and CBDC, central bank digital currencies. Could you comment briefly at least on that? Thank you.
Do you want to go first, Daniela?
I don't mind whichever way. Maybe because I went first for the first time. Why don't you go ahead first and see if I have anything meaningful to add?
Well, it's very hard to be opposed to innovation, and it's very hard to be opposed to competition, to some of the things that the banks do. I just sent some money off to my old university, the University of Manchester. When I looked at the exchange rate, my safe and sound bank gave me, let me tell you, I had to give it a second thought. So I'm all for innovation and I'm all for competition. But as always, and you can go back to the Greeks if you don't want to go back to the Bible, moderation in all things and try to think things through. And one of the difficulties that I've had, I guess, and I've seen this, this goes back to the comments that Daniela was making, is that we have had enormous amounts of financial development and financial change in these shadow banking systems and the rest of it. But nobody thought through, or for that matter, even tried to think through what the implications of these what the unintended consequences of these developments might be. And so if you have a whole sort of analytical approach that just simply focuses on efficiency without thinking in terms of safety, resilience, sustainability, then we have a problem. And that has been the attitude up until now. And I'm actually hoping that the coronavirus, I mean, you know the expression, every cloud has a silver lining, that what the coronavirus has shown us is that resilience is important. Preparation for bad things is important because bad things happen. And so I would say, yes, absolutely, proceed with both financial innovation and the fintech initiatives. But we should spend more time thinking about not just the efficiency that they offer, but some of the dangers that might be associated with them. And in central bank digital currency, yeah, that really is profound because as I have not been following this as closely perhaps as I should, but certainly one of the things that I know they're worried about is that if you give retail access to central bank digital currency, whenever there's the slightest problem, money will get drawn out of the commercial banking system back into the central bank banking system. And then the question is, what are the implications for the commercial banking system? And one answer to that, and I'm not saying I support this answer, but one thing that you might say is that if you're going to have the central banks in the retail banking business, and that creates a condition of great instability, then one answer, and I'm not recommending it, is that you simply get the banks out of you get the banks out of holding those kinds of short-term assets that are equivalent to money. But then we're back to narrow banking, which is a proposal made back by some Chicago economists back in the 1930s. And I say this only to note that these issues touch, as Daniela mentioned, on some of the most fundamental questions having to do with the operations of a monetary and financial system. So when you get into this stuff, and I think the central banks are being very careful about it. You know, the BIS has set up a whole new unit to look at this kind of stuff. You're going to be very careful to ensure you know what the implications are of what you're doing, not just today, but tomorrow.
Thank you. Maybe I can add a couple of things. We now, if I understand it correctly, we now use the term crypto assets to sort of highlight the fact that the usual term, which is cryptocurrencies, is a misnomer in the sense that it suggests that these cryptocurrencies are money, but they are not money. To my mind, they are speculative vehicles that move a lot in value. They cannot credibly store value like we would expect money to do. For now, I am very relaxed about them in the sense that I think there is a lot more sort of PR going on and some sort of competition for generating this kind of assets than the real threats that they can pose to the financial system or to the real economy. However, I think the question of unintended consequences should always be there, and I would start to worry along the kind of lines that we have since 2008. Is there interconnectedness generated in the system? Does it allow for leverage? I don't see that for now, but innovation is always about making sure that you move away from the kind of money that is regulated by the state, because that's expensive to produce and it's expensive to hold, and you move into private spaces where there is a bit more space for financing activity with money-like type of instruments. I'm pretty relaxed about crypto assets because I think there is not anything significant yet in systemic terms there. And if people want to lose money betting on Bitcoin, is their problem. On central bank digital currencies, I would agree that that the main issue here, I think that central banks have been reluctant. They've been thinking about this for a while. They've been reluctant to propose central bank digital currencies because they create the very problem that Bill identified. If you can run from private money-like instruments towards the central bank in crisis, then the central bank has a very serious problem on its hands, because the private financing markets are going to experience runs, and you don't want that to happen. So you have to design a very clever system of incentives and prices and limits on how much central bank digital currency you can hold as an individual or as an institutional investor. What if my pension fund runs away from financing, I don't know, European banks into holding its cash with the ECB or with the Bank of England? That would be a problem for banks, right? So there is a lot of it, I think, is driven by the fact that we have private institutions, particularly social media kind of companies, that are trying to produce the equivalent of state-backed money without accepting the regulatory regime around it. And that's, central banks are just trying to sort of keep pace with innovation in the private sector. I don't think it would go very far. I am not very either worried or optimistic about the future of central bank digital currencies.
Yes, thank you very much. Before I move to the questions, I would like first to invite everyone to put your questions in the FAQ function, and also vote on the questions of your fellow listeners, because this will ensure that we get the most interesting ones then to the two speakers. But I would first like to ask the two of you one question, which is perhaps trying to organize a bit your arguments. I found it very interesting that Daniela was insisting so much on the importance of what she called market-based finance, while William White, he insisted so much on the issue of forbearance and ultra easy money. So I would therefore like to turn the things around. Probably you have had your reasons why you, Daniela, were not stressing so much the two issues raised by Bill. And on the other hand, you probably had your reasons why for you the growth of what Daniela called shadow banking was less of your concern. So can you comment on the perspective of the other in order to understand where the differences and convergences of your two positions lie? Perhaps I start Bill to go first.
Well, the reason why I chose to speak on what I spoke on was because when I got the original, the original invitation, it was mostly to do with the forbearance issue. And then, as I say, the final version came out with an agenda for financial regulation during the pandemic and beyond. And there we have, during the pandemic, is crisis management and crisis resolution. The beyond is crisis prevention. And these are all sort of different things. And they're all very important. Okay? So I, just by happen chance, followed up on the crisis prevention, and the crisis management. And I didn't get a chance to get into my comments on crisis resolution. And Daniela has chosen to talk about crisis prevention. I've written a lot about that, about more fundamental reforms going forward. And I guess I am of the view, with respect to that going forward, that the most fundamental problem we face with respect to regulation is that it is not attuned to what is going on with respect to monetary policy. That the biggest problem that we face, indeed the last three major downturns, aside from this current one, have not been economic downturns that have come out of too much inflation. Okay? They've come out of disruptions in the financial markets. and they're, basically sort of boom and bust kind of situations that got progressively worse until we got to the great financial contraction. And dealing with that really ought to be the primary concern of the official sector. And to my mind, what that would involve would be both regulatory policy and monetary policy leaning against the wind, and to, in somewhat different ways, as I've argued, also leaning against the downturn. But of course, what we have had in recent years is two totally different silos, as if the supervisors and the regulators were operating in one world and monetary policy was working in another. And the most recent example, since 2008, you've had monetary policy everywhere, but certainly in Europe, monetary policy with its foot firmly on the accelerator, and the regulators with their foot firmly on the brake. There's something fundamentally wrong with the way we're approaching these problems.
Thank you, Daniela.
Thank you, Sven. I guess one very easy answer would be that Bill and I coordinated to make sure that we don't repeat our message, since in some ways it's quite similar. Right. Which is that, and I would very much agree that there is a question of what is happening, what are the unintended consequences of the measures that you're taking now, and what is the political willingness to undertake the kind of structural reforms, the painful reforms that Bill referred to. And I guess the message given the audience and given the interlocutors of this, the message here is that sometimes you just have to take political pain and push with structural reform in order to make sure that you have a system that is functionally much more useful for the real economy and much less damaging to climate and much less favorable to the financial system and to financial system players. And I don't think that our message is very different in that respect. I guess it's quite complementary in the sense that, yes, very low interest rates, we know in the literature, means that you encourage banks basically and shadow banks to engage in this risk-taking channel, which is to accumulate more and more risk, and then you try to stop them from taking these risks with a regulatory regime, which is already a bit like a Swiss cheese, because it has lots of different holes that are carved by very clever people in suits. So that's a problem, obviously. I would say also that in a sense, there is something more fundamental here at play that I would like us to remind ourselves, is that for reasons that have to do with the dysfunctionalities of the euro area, in particular in this case, we have left monetary policy to do the heavy lifting where fiscal authorities should have done the heavy lifting. And they cannot do the heavy lifting for reasons that have to do first with the reluctance of the European Central Bank to provide support to authorities from the beginning in the way that they are providing support now in the pandemic. When Madame Lagarde says, I'm going to target spreads, she basically says, spend governments and we are here to support you. If this had been done in 2008, we would have a very different financial system now, because the appetite for doing regulation, for doing structural reform would have been much more significant, since the pain would have been less, I would say, for European citizens. But when you create conditions where monetary policy is in the driving seat, where technocrats have to take political decisions that are political with small p and big P, then of course you get the worst of both worlds. You get very limited regulatory reform and the wrong tools to address the very significant problems.
Thank you. That was clarifying that even my first try to really put a bit of division between the two of you failed totally. And I will therefore move to the easier ways of moderating and read some of the interesting questions which have been posed. So perhaps you take some notes and try nevertheless to be concise in your answer. So first, Christian Bernard of the LPM Academy, whatever that is writing, perhaps I'm too naive, but why can't we divide the banks into traditional investment and credit banks and speculative banks? These could then be treated differently in legal terms. So Daniela already referred to the famous Liikanen Report, which offered a soft version of that. But William didn't comment on it yet, so perhaps this may be enlightening. So then Josefina Bayer, I'm not sure, is saying the following. BlackRock is a very big problem indeed. Why are they and others like them not involved more in EU regulating security processes and are able to put woods and other common goods? Not fully clear to me, however.
Sorry, Sven, there is a continuation to this question somewhere.
Please.
Further down.
Can you read it?
Yes. It says, sorry, unfinished sentence in the last post. The question should be, why are they able to put common goods on the sale table, like woods or land? I mean, BlackRock and others are selling everything that is possible, even air if it would be possible. Well, yes, they are actually thinking of selling air, so it's a good intuition.
If you take over facilitation as well, probably the result would even be better. Thank you for helping out. Basically, I would say you answered already, William, the question of Alison Schultz, but perhaps you want to take that further. Thanks for your convincing summary of the problems of easy monetary policy. What's a decent alternative to this policy in the current situation? So perhaps that is a bit new. And I would like to pick myself here one question of a distinguished person in Brussels. This is, of course, Karel Lanou, who is the boss of SEPS, one of the key think tanks in Brussels. Well, and he's daring to say, I do not agree, Daniela. Market-based finance has declared a lot since 2008 towards a more traditional banking system, and the shadow financial system is small as compared to total banking assets. So perhaps the point here, and now first to Daniela.
Thank you. So would you like me to address all the questions, or? You
can pick and choose, but you are free. So I'm not so authoritarian. You are the Greens here. So
okay, so I would say, maybe I can leave the question of why have we not been able to separate the sort of investment banking / market-based activities of traditional banks from their regular loan and deposit making activities. Maybe I can leave it to William White, and maybe I can also leave it to you, Sven, because you've been in the European Parliament a long time, and you can tell us why the bank structural reform directive is sitting in somebody's drawer instead of having passed through the European Parliament. That would be an interesting answer to me as well. But of course, it's not a question of technical feasibility. It's a question of political will. And I will stop here. And the trade-offs that are involved in choosing this alternative. I will maybe address the question on BlackRock, because I think that's an important question. And it's important for a variety of reasons. Probably the single most important one, so BlackRock is an asset manager. It manages assets on behalf of institutional investors like pension funds, like insurance companies, high net worth individuals. Lots of different types of investors give their money to BlackRock, and they say, well, can you make these investment decisions on my behalf? Now, BlackRock has been in the news a lot in Europe because it presents some very interesting paradoxes. So we know that the US under the Trump presidency is not very interested in climate politics, to the extent that it doesn't want to participate. It withdrew from the Paris Agreement. It's not very interested in trying to think particularly about greening finance. But BlackRock has been very active, very overtly in trying to influence the green finance agenda of the European Commission and the green finance space generally in Europe and abroad. And it has been in March 2020, this year, we had a very significant scandal, I would say. I mean, some people try to make it into a significant scandal. I hope it reached all sorts of audiences, because BlackRock has a very poor record on trying to push through, because they're majority shareholders of lots of different companies. They have a very poor record in matching their rhetoric of commitment to the climate crisis with their actions in pushing companies to green their activities, to reduce their carbon footprint. And so that's one problem. That's the context. The problem with BlackRock is that it's now advising the European Commission on how to create a framework for banks to green their activities. Let's put it this way in very big terms. And for many people, this is a very clear conflict of interest. Why are you asking a financier of carbon activities to design the regulatory framework for reducing the carbon footprint of financial institutions? The conflict of interest to me is very clear, but somehow that BlackRock is there. The European Commission insists that there is a Chinese wall between this advisory part and the part where BlackRock is actually trying to increase its market share in green finance by offering so-called green products. So to me, the worry is, in a sense, that this is part of the story that I've been telling you, which is that European regulators work very closely with private financial actors in order to design regulatory regimes that celebrate innovation, but do not take into account unintended consequences. And here, the unintended consequences are very massive, because we are talking about systemic greenwashing. And BlackRock so far has been one of the most systemic and significant greenwashers I can think of. Precisely because it's so big, and because it's the difference between its rhetoric and its actions is so significant. So we have no ways of holding it accountable. We have given it a lot of regulatory power, because, you know, if you've been to Brussels, and I go to Brussels regularly, if you've been to Brussels, BlackRock is in every corridor, and it's talking and whispering in the ears of regulators, and that's a problem. I would hope that in the same way that we don't allow tobacco companies to design our health policies, we shouldn't allow BlackRock to design our green finance policies. So maybe I'll stop here, because now I've talked a lot, and maybe we can come back.
William White.
Well, I just follow up on what Daniela said and say I agree with her, but not totally. I think that it's clearly important to consult with the private sector people and find out what they think about the proposals that are being made by bureaucrats or whatever. Because very frequently, and I've spent 50 years in this business, it's very easy for us in our institutions, central banking institutions, whatever, to get it wrong. You should be consulting. But the fact of the matter is that it ought to be the regulators and the central banks that keep firmly in their minds the unintended consequences and the medium-term implications. And sadly, I fear that up until now, perhaps there hasn't been as much emphasis on that as there should have been. On these other questions, you know, the business about why can't we have two different sets of banks, commercial banks and investment banks? You know, we went for a century, I guess, with there was such a distinction in the United States. And then it gradually sort of got eaten away until finally at the end, it got eaten away so much that the Fed was providing support to everybody, not just the commercial banks like in the old days. But Europe has always had universal banks. And so you've had these two models, and they work pretty successfully for a long period of time. And it does seem to me that we could go back to that separation if there were the political will. There's only one problem, and no, sorry. One of the problems is that you would have to make a very solid case that it was the sort of the investment type banks that were getting into trouble or causing the trouble, as opposed to the commercial banks. And yet, when I said before about earlier on about the last three downturns have come out of the financial markets, one of the important factors underlying it all was property. You know, and the way property has been used as collateral, and the way in which people suddenly realized that its value was not as high as they thought it was going to be, and then there was a run, that comes out of the commercial banks as much as out of the investment banks. So, you know, there's an issue there that's got to be resolved. What's the alternative to ultra easy monetary policy? I think Daniela made a point here a moment ago about wouldn't life have been different if the European Central Bank had sort of done something different in the early years of the financial crisis. I think looking back on it, one of the big mistakes that we made was, I'm thinking now, what, 2009, 2010, 11, and then even more so in Europe after the European crisis. We basically said we have to have fiscal austerity, or at least we have to cut back on the use of fiscal support for the economy. We also embarked on a heavy program of re-regulation, which basically sort of tightened the supply of credit. And so what you were left with was fiscal was contractionary, regulatory was contractionary, monetary policy was the only game in town. And some of us hoped that, you know, the temporary use of this might come to an end. But of course, as we know, it continued almost up until the beginnings of the pandemic. And that, I think, has been a real problem. So where do we go from here? My sense of it is that there is room on the fiscal side. They've used that room in the fiscal side. They should have used the room in the fiscal side. They shouldn't pull back anywhere near as quickly as they did last time. That at least will cut off worsening the unintended consequences of easy money. It will, of course, increase government debts, and I'm not happy about that. But look, in a bad situation, you're choosing the least worst of the alternatives. And I think that governments could aid their case for maintaining fiscal stimulus by laying out a path for how they intend to go back to something stable on the debt ratio side over time. I'm not talking about a German-Swiss debt rate of the past sort, but to provide some kind of an anchor going forward by borrowing very long at very low interest rates. You can lock in your debt servicing charges for a long period of time. If they gave a clear indication of how they intended to get the debt back under control, the kind of taxes and the taxes that they thought they might have to raise, and I could think of a number of them, not least carbon taxes and that sort of thing. Tax expenditures, which are frankly a bit of a disgrace virtually everywhere, used as a kind of subsidy that's under the curtain so that nobody sees it, money going to vested interests. The kind of expenditures that they think they'll have to sort of position away from, clear indications of how they will do something is every bit as important as a statement, we have the firm intention of doing it. You know, I don't think that's going to convince financial markets. All of that would be helpful. But most importantly, as I said before, if our big problem is debt and an overhang of debt that comes out of 30 years of monetary policy, and unfortunately also a fiscal overhang that comes out of the fact that we never tighten fiscal policy as much in the upturns as we ease in the downturns, okay? If we've got a debt problem, we should confront that debt problem directly. We need more debt restructuring, debt forgiveness. We need far better administrative and judicial procedures to do that. The IMF has been complaining about this. The BIS has been complaining about this. Working Party 3 at the OECD has been working on this for 5 or 6 years. The Group of 30 wrote a piece just a year ago, all of them saying our capacity to resolve debt is inadequate and we should be doing more along those lines.
Yeah.
Oh, and shadow banks. I'm sorry, I just finished with this. Is shadow banking a problem? Yes, it is a problem. And Daniela is quite right to point out the fact that the complications and the interdependentness, you know, it is a problem. The FSB contends quite vigorously that the problems that we had that were referred to as shadow banking problems during the crisis, that those problems have been fixed. And I think they're probably right. But the problem with the sort of financial system, which is a complex adaptive system, is that tomorrow's problem is going to be different from yesterday's problem. And the big difference there, and it goes back to BlackRock and all these guys, is that there's been an explosion of asset management companies. And where this all leads, and I mean, this is another sort of issue, if you want to think fundamentally about re-regulation, you sort of say, where did all this regulation come from? And it starts off with banks. There are runs on banks, okay? And that's extremely costly. So then the government's put in place safety nets to make sure there's no runs on banks. But if you've got safety nets, then you've got moral hazard. And if you've got moral hazard, then you need regulation. And so you get regulations on banks. But regulation just leads to evasion. And that brings you back to the shadow banking system that Daniela was talking about, sort of, okay? And so you get exactly the same thing happening with them. And at the end, you wind up with regulation on the then shadow banking system. And then the system adapts again, asset management. And the real worry would be, and maybe we're seeing it already, is that then the whole cycle starts all over again, is that we need safety nets for the asset management companies. And then just like monetary policy, when you view it over a very long time period, you're on a path which is unsustainable. So fundamental reform would start off with thoughts like that, about how do you get off that path?
So, well, look, in a certain way, William, you arrive now again at the point which Daniela opened in the beginning, that the logical consequence of the shadow banking system is that central banks will start to stabilize the markets. And this is basically, in other words, what you just predicted. And of course, therefore, you have a new form of safety net, which requires a new type of regulation for those who are playing on these shadow banks, who are playing in the shadow banking system. Well, and so in a certain way, your intervention fits in nicely with what Daniela said before. So why was the separation, the banking separation, failing after the crisis? We owe Daniela the answer, and I remember very well, Ernest does probably as well, because we were on the same committee at the time. And the response to the Liikanen Report, which was a soft version of the banking separation model, which of course comes from the US and was applied there successfully, at least for a long period of time. What happened? In Europe, you always need two to tango. So it took a long time until the Commission proposed a watered-down version of the original watered-down version of the Liikanen Report. So we saw a lot of pressure from the banking sector on these proposals, and unfortunately, the Main Street banks did not support vigorously the model. Very often they sided with the large investment banks because you were saying, William, we have the universal banking model, which is only half true because we have lots of banks which in Europe, which have very little to do with investment banking. And but they didn't support the model either. And in the big banking federations on the national level, you usually have both together. And then the logic was the boring banks were basically supporting the investment banks against these proposals. And then, so therefore, in the big member states, there was very little appetite. So the same basically, Spain, Germany, France, Italy, all defended or thought they have to defend the universal banks. The most positive were, by the way, rather the Brits, which were more open. But however, in the end, in the Council of Member States, there was very little support, and the Parliament was exactly split. So it was really half of the committee was in favor and the other half was against. And it's very simple. So Greens, Social Democrats, and Left were in favor, and the Conservatives, Christian Democrats, and ironically the Liberals, which is a bit bizarre because it would have allowed a better functioning market, they were also mostly against. And therefore, the proposal was never voted in ECON, it was never voted in Council, and finally died. But therefore, you know now who was responsible. And the last point is that I also think in academia, there was never a strong consensus over it. So the finance academics were also split on the proposal. So there was not a strong consensus which would have helped policymakers to overcome the power of special interest lobbies. So that was how I saw it.
I think one of the problems, I mean, I'm glad you raised this issue of special interest lobbies, because I was intrigued when you were talking that it was the sort of the small banks that were opposed to the Liikanen proposals. But on second thought, it doesn't surprise me, because if you were going to get the big banks who sort of treated their retail business as being sort of a second-class business, but you would divide them up, okay, so that now you had a standalone retail business, it would be a direct competitor to all of those, you know, the Sparkassenbank and those kind of state-controlled banks. And I would also add in, and I don't know anything about the politics, but we all know that many of those smaller state-owned or affiliated banks give the politicians an awful lot of influence. And so their immediate reaction would be, let's not vote for something that would give still more competition to the bank that I help run. So this is where you do find, you always get into it. I mean, it's not just the economics, it's the politics. And it's a question of who's, you know, the English expression, whose ox is being gored, whose interests are being hurt.
Well, look, William, you, as a German, I can only say you are not supposed to criticize our Sparkassen. Beyond that, but seriously, the trouble obviously is that they are also having their own type of semi-investment bank. And that is, of course, part of the problem. But I would give a few more questions a chance to be listened to. So, Bill, you were saying we should more tackle the ultimate origin of the problem. So if there's too much debt, or one could also say too much finance, because obviously both sides of the balance sheet belong together, we have options like forgiveness, better restructuring of debt, and in the end, there's one question fitting nicely to these, and this is by Roman Ciano. If everybody creates money, and this money is not destroyed in bank crashes as used to be, there's more and more money in the form of debt, financial assets, etc. And if then you inject more money, then you make it worse. Can be high taxes a way to remove and destroy all this excess of financial assets? Because this is an option you were not suggesting in your list. And then there's Hans Florian Hoyer asking, why are low profits in banking, probably he means, a problem? Don't we need dull banking? So which would mean low profits expel greedy bankers? And then there is also a question by Miriam van der Stichele, and you cannot have financial seminars without Miriam van der Stichele. Therefore, I want to read this question here. She works for SOMO in the Netherlands, a well-known corporate critical NGO in the Netherlands. Regarding asset management market, investment fund industry, what are the most important regulations which are needed? Splitting up the biggest asset managers might still create new smaller asset managers. Do we have to forbid ETFs to be too big and investors having the right to get out any minute? Is a bit, what more regulation needed for all players in the shadow market? So I suggest to move on from here. Who starts now? Perhaps again back to Bill.
Well, there are so many questions there.
You can pick, and you leave the rest to Daniela.
Okay, well, let me do, I think, what are the last two? The business about sort of the liquidity offered by asset managers. This is a real problem. There's a recent paper by Nellie Lang of the Brookings Institution that sort of talks about this range of territory. You may remember Mark Carney said about 2 years ago, the problem with these institutions is that they are, quote unquote, built upon a lie. And the lie is that the assets of the institution are illiquid, but you can get the liability holders can get their money out in a liquid way on a day-to-day basis. And this is just very dangerous. And I absolutely agree with that. And I think that there should be longer lock-ins for some of these liabilities. And the worry, of course, that you have, and I think Nellie Lang's article really focused on that, is the possibility of runs. So that the asset management firm starts to lose money, the assets start to go under, the people that hold the mutual funds, let's say, observe what's going on. They know they can get out, and they do, and in consequence, then you get a run. And this is it's like I said before, it's the same old problem with the banks. It's just now 3 layers down the financial structure. So yeah, that's something that I think people should do something about. The business about splitting up, this is something we've worried about for a long period of time, that the big institutions are too big, they're too complicated, they're too complex to fail, too big to fail, too complicated to fail. Why don't you just split them up and deal with the consolidation problem like that? But as many people have pointed out, if you have a sort of a common business model, even for a large number of smaller firms, if they're all exposed in the same way, they may be individually healthy until something happens, and then the whole system is still prone to collapse. So it is important to recognize that even a bunch of small firms can get into trouble in the same sort of way as a big firm can get into trouble. Higher taxes in response to financial complexity, that one I'll definitely leave to Daniela. And the question of why low profits are good. And I think there were others, but I missed them. So I don't know, Daniela?
Okay, I'm a bit disappointed, Bill, because I started to think that you sound more anti-capitalist than I do, which is quite paradoxical in many ways. But I would say, taxes could be a good idea, but politically they seem as unfeasible as any other measures to introduce structural reforms. And I'm thinking here in particular about the financial transactions tax. I don't know what taxes you have in mind, but the FTT, as it was designed by the European Commission in the days when the European Commission really wanted to do something about structural reform, it was aiming exactly at this market-based financial system that I described. It targeted the repo market, it targeted derivatives trading, it targeted all the kinds of activities that we would like to, in an ideal world, to shrink, because it's so difficult to contain the systemic vulnerabilities.
Yeah.
And I'm sure Sven can tell you a long story of how that particular initiative failed on the basis of the member state that he comes from changing its mind at the last moment about the desirability of having a financial transactions tax. You know, always the sort of knee-jerk argument is you can't have any successful taxes if they're not done on a global level. When somebody says that, it means there will never be a tax of any sort, because global cooperation on taxes is nearly impossible. So I would say it is within the realm of the technical solutions that we have, but politically it's quite difficult. It's never too late. I didn't have time to elaborate, but I think if we want to think strategically about the windows of opportunity that we have, particularly given that we talk to green MEPs, the fact that there is a growing regulatory appetite for channeling the financial resources and financial flows away from high carbon towards low carbon, we can have, for example, a green financial transactions tax, which basically punishes dirty assets, or punishes transactions in dirty assets. Once you have a way of identifying dirty assets that is tight, that is not open to greenwashing, then of course you introduce a financial transactions tax, and you say, okay, if you want to finance, if you want to hold positions in assets that are dirty, you're welcome, but we will make it expensive, and we will raise the money to finance, I don't know, public infrastructure in the euro area. So that is a possibility. We have to think more strategically about that. So in that respect, I don't have, I think it is an avenue to think of. And what was the other one that I wanted to, low profitability in banking. That is another, this is like when I think there is a holy trinity of arguments in the European space about that motivate the regulatory agendas. One is SME loans, the other one is low profitability in the banking system. So we talked for almost 2 hours here, and I can give you quotes of many large universal banks in the euro area that are making quite nice profits now. So and they're making nice profits, particularly from the kind of trading activities that I described as associated with market-based finance. So of course there is a problem of profitability, and particularly for the smaller banks, when this wave of non-performing loans is going, if it's going to hit them on the scale that we expect them to be hit because this pandemic doesn't stop. But I would say that the sort of, this is putting the cart before the horses, arguing that we have to worry about bank profits. We have to make sure that banks can run on a basis that they can create the kind of credit that we want them to create, and that is credit to green activities, not to brown activities. And my worry with the way in which we've been thinking about debt restructuring, because that is what the securitization of non-performing loans is, in a sense. It's an idea of a market-led approach to debt restructuring that says, I will make it easier for you banking system or banks to move bad assets or non-performing assets from your balance sheet, and I will create the regulatory incentives for you to get rid of those in ways that are not going to impair your overall lending activity. Now, when you say that, when you allow the private financial system, again, to design the rules, the dangers are, of course, that they will game the rules in ways which are counterproductive and have unintended consequences. And my worry is that one of these unintended consequences is that instead of putting their mortgages extended to households that have been hit by the crisis and in very significant ways, they will put stranded assets that are the result of greenwashing. This, I don't know who's thinking about that and how regulators are taking this into account, but that is a significant worry. And I just want to answer to Karel Arnoux. Hi, I hope you're still there. I strongly, not strongly, but I disagree with your characterization of the fact that we are returning to some sort of traditional bank-based financial system in Europe. It is true, securitization markets have shrunk in Europe. They weren't very big to start with, but they've shrunk significantly. And the most significant securitization activity that has happened until very recently has been on the back of preferential treatment from the ECB in the collateral portfolios, in the way in which the ECB accepts particular types of assets for its monetary policy operations. But the repo market is still very significant, and I would say it hasn't shrunk that much compared to the securitization market, and we still have regulatory initiatives that seek to promote securitization in ways that I think we have to consider very carefully whether they will generate the kind of misincentives that we had before the crisis. And thinking more on the broader picture, more structurally, I would say that the regulatory regime that we have in place now is again market-led or private-led, and that's something that we need to think about in relationship to the climate fight, because I strongly believe that we cannot allow, knowing the lessons from history, we cannot allow private finance to design the rules of greening the financial system.
Yes, well, just one small point on that. If you get, up until now, if you got financial regulation wrong, you could always go back and fix it. My sense of it is if we get the climate change thing wrong, there's no going back to fix it. So that's an issue.
Bill, you are really providing a really nice bridge to the final question I would like to share with you from the audience. And this is exactly back to the For Future element of our inviting title. And this is by Simon Scheirer. And he is asking, can climate change be tackled with a financial system that is based on growth due to compound interest on the credit money it issues? And second, the profitability motive of money creation inscribed into the nature of commercial bank money creation? If the answer is no, what would be your alternative? Of course, the question is, do you agree with the question? Shall I read it again?
Yeah, please.
Can climate change be tackled with a financial system that is based on growth due to compound interest on the credit money it issues? And second, the profitability motive of money creation inscribed into the nature of commercial bank money creation? If your answer is no, what would be your alternative? You know, Germans and German speakers love to connect lots of nouns into very long nouns, which then are difficult to disentangle. And we regard the translation of that as English, but I'm only making jokes about my own English. Yeah? So, but before I leave you totally confused, Daniela, do you have some thoughts to share with us on this?
I mean, I think that there is a literature on degrowth, and there are political arguments around degrowth that I am not an expert in for a variety of reasons. Also because I haven't worked it out very clearly in my head, whether the answer to is capitalism and the climate crisis, can we solve one without getting rid of the other? And I'm not very clear on what the answer is. I also come from Romania, so I'm not very clear that we have an alternative to capitalism in which the climate crisis can be solved in ways that are politically, let's say, pragmatic. So I don't know what the answer is, but I know that we can take very, very significant steps towards shrinking the size of the financial system by simply penalizing dirty activities and dirty assets and supporting a bit less than the relative penalizing, supporting a bit less the lending to green activities. We don't need to go into, I would say, much more difficult philosophical questions of whether capitalist finance is consistent with a reversal of the very rapid deterioration of the climate that we have. But maybe Bill can answer this.
I'm just sort of trying to think here. I mean, that the premise seems to be that and I'm sure I haven't understood correctly, that if you want to sort of raise the finance that's required in order to give us a greener and more sustainable future, that will really sort of compound the debt problems and make certain problems worse. I guess my sense about where will the finance come from for green finance is that the numbers, in fact, are not all that large. We are talking perhaps trillions of dollars here of infrastructure, but in the great scheme of things, it's not as big as all that. I think what we need, and this is going to be difficult, of course, for people to accept, and we're back, I'm finishing where I'm starting about sort of the solving today's problems as opposed to solving tomorrow's problems. In order to generate the resources to get the investment for the infrastructure and everything else that's required for this transition to a more sustainable environment, there's going to have to be more investment and less consumption. And what that means is more for tomorrow and less for today. And a lot of people are going to find that very hard. And I would say more broadly, and I'll finish with this, I have an article which is coming out quite shortly, which is called "Why the Four Horsemen Must Be Dealt With All at Once." And the four horsemen are the four horsemen of the apocalypse. If you go back again to, not that I'm a religious person, but going back to the Bible. And the prophet Ezekiel talks about these four horsemen, which are basically famine, war, plague, and all too common 3,000 years ago, death by beasts. Okay, and when you think about the modern day analogy, it's the economy, which is not doing well. It's the politics, which is not doing well. And the politics, I think, is in large part based upon the income and wealth inequality. I think there's a fundamental issue there that needs to be dealt with, of inclusiveness. And then you've got, of course, the pandemic, and then lastly, the environmental problems. And we're going to have to find some way to make some compromises to deal with all four of these things, because any one of them is capable of bringing down the whole system. It's a bit, some of you may remember the opening line of Anna Karenina, Tolstoy. It says, "All happy families are the same, but each unhappy family is unhappy in its own way." And what Tolstoy meant by that, I think, was there's a lot of things that have to come together to make it all work. And at the moment, there's a lot of things that have to come together to give us a sustainable future. And that is going to be the great political problem going forward. And as we were talking about before, it's not just, financial transaction taxes. You can't do it unless it's global. A lot of this other stuff is going to have to be global too. And that's something that our political masters, including yourselves, we're going to have to come to grips with. There's some big compromises going to have to be made, not least the role of the state as in opposition to the multinational, supranational, and subnational elements of government.
Well, look, first I have to say a very warm thank you to the two of you. The convergence was a lot bigger than I expected in the beginning. I thought we would get a big quarrel over the role of monetary policy, which was much less than I predicted. Although one could, of course, hear that the stressing of different phenomena was different. William, it was very difficult for me to stop putting you into a theological discussion with your recurrent references to the Bible. my colleagues in Econ know that I have a big love for these debates, which I find much more important and fundamental than these boring finance issues. But I was trying to resist this temptation. I'm daring to ask you whether you are the Pharaoh of the first reference to the Bible you made. However, beyond that, I found that there is one very bad news for those who believe into big economic alternatives. The bad news has very much to do with what William just said. If we want to tackle climate change in the next 10 years, we cannot first invent an alternative to our monetary system, to our capitalist system, or whatsoever. We will have to solve the climate crisis in this economic system. We have to ride the tiger. This is really difficult. I'm not saying that this is the end of the discussions about economic systems, certainly not. But who claims we first have to reinvent totally all the economic fundamentals? Well, I must say, this is in a certain way a modern theory of suicide. And therefore, I believe we will have to tackle this in the existing framework. The confusion about the last question probably is that there's a long tradition in Germany and Austria about the belief that the existence of a positive central bank interest rate has to do with the growth, or leads to a growth imperative, which I personally doubt. But there's a long strand of literature going back to Gesell and many others, which confuses many people from the Anglo-Saxon world. But that is another debate. I personally do not share this point of view. I rather believe that at least in the period of investing into the future economy, there's very good reason why we will need an expansionary period in order to overcome the green crisis, so the crisis of climate change and biodiversity. In the long run, of course, it's just true what William said, but in the short run, in the investment period, there's no contradiction between greening the economy and an expansionary investment-driven push. But where we converged here in any case was that the expansion of the financial world is not the right answer to the current situation. So, and it is a dangerous answer. So we rather need reforms. I do not like the term structural reform, because in Europe it is always used in order to justify some sort of one-sided austerity policy. But we need structure, we need reforms which make investment into the green future more profitable and more attractive, and we need less of financial expansion, in particular this financial expansion, which is not clearly targeted and helpful for the investment push we need in the real economy. And that is, I think, a recurrent theme of the green position in the Econ committee. We just voted today against another package of relief towards securitization, which seems for us not the right answer to today's problems. So therefore, we are very much in favor of supporting the real economy in order to green our production model, and also for a financial system which is financing just these investments. But we need a lot less of debt for its own sake, finance for its own sake, and even less so, we need a financial sector which is too big to be regulated, because it is basically creating the political opinions itself. And there, I think we agree, and we have already achieved first steps in the parliament that we should be very careful with the new type of mega players in the financial sector in the field of asset managing, which was here named as BlackRock, State Street, Vanguard, and many others, who from our point of view, I think are more an issue for cartel authorities than a player in the financial sector, which we should allow to expand ever more. But that is an issue which we certainly will tackle in a special session. And I really thank you for the contribution you made. We will continue our work in the ECON committee, and it's great that so many people endured this, for me, fascinating discussion with a lot of insights and this love affair between the two of you. And I wish you well and all the best. Good night. Thanks to everybody who contributed, the translators, those in our teams who helped preparing it, and of course, in particular, Daniela and Bill. Thank you, and see you.
Thank you. Bye-bye.
Bye-bye. Pleasure. Thank you.
Thank you so much, Daniela. And
good night.
Thank you, Ernest.
Good night. Bye-bye.